Okay. Well, welcome everybody. I know it's 10 o'clock, so we're going to get started. I just want to make sure everybody can see the presentation okay. I don't know if you can give a thumbs up. I know that we don't have audio. So if you can see the presentation, it should show. Okay, so I see got some thumbs up there. It should show budgeting and market trends, what they mean for you. Okay. Okay, awesome. Well, we got a handful of thumbs up there. So we'll just hop right in because I know a majority of what everybody is on here to talk about are the market trends. It's been a crazy, last couple of weeks. The second quarter has gotten off to kind of a rough start. Um, if you remove yesterday's big uptake, we'll talk about those in a minute. And so it's been on a lot of people's minds. Obviously, if you're on this webinar, you may have received the market outlook and review from Ben. If you did not, give us a call or shoot us a message over email. We can resend that out or send that out to you for the first time if you haven't already received it. Ben made some comments at the beginning of the quarter, so just a week and a half ago, and just kind of our views and his views on what has happened in the first quarter, beginning of this year, going forward. We're going to touch on a couple of those things a little bit here today, and also bring it current to April 10th, right? Because that would have been current as of April 1st. So just because a lot has happened in the last couple of weeks, that would have been impossible to predict. Now, our regular topic was supposed to be budgeting. And so we'll touch on that a little bit, but then get to the good stuff here. So let's and as a reminder, there will be points when we stop through here for questions, a Q&A, things like that. I think we have in the middle and then at the end as well. So there'll be a couple spots where I will turn back to the Q&A portion, throw out any questions as they come to you. If you're coming in with stuff ready, you can throw it in there right now. No need to wait until we stop. You can throw in questions or things that may be on your mind. So let's continue. Like I said, today's agenda is budgeting strategies. Just briefly, probably use about maybe 10 minutes on that, 10 to 15 at most. And then about 20 minutes going through recent market activity, inside stuff that we're seeing, and recommendations that we have, and what it means for you and your portfolio going forward. Like, what should you be doing? What should you be thinking about? I preface all of this by saying, with the budgeting and market outlook activity, if you have any questions outside of this webinar, give us a call. That's always our invitation. Give us a call. It's not, we don't have an hourly retainer or hourly fee or retainer or whatever it might be to work with us. If you're a client, if you're a 401k participant, give us a call. We're happy to talk through whatever you have going on, whatever questions you have. I mean, that's why we're here. That's why we do what we do. So, So the reason that we want to talk a little bit about budgeting, and that was part of, if the markets have been going pretty stable, we probably would have spent the whole time on it. The reason we feel like budgeting matters is, it's pretty common out there, but there's a recent study that shows that most Americans wouldn't be able to cover a $1,000 expense if it came up, like an emergency, a bill, or something like that. And so if you feel like you may be in that spot or living paycheck to paycheck, you're not alone. Most of America is living that same way, in one way or another. So budgeting is incredibly important. It gives an opportunity to sit down and really see where money is coming in, or how much money is coming in, where it's going out. It's pretty common that when somebody has a written budget, that they're going to be, at least twice, if not more, likely to feel financially stable. When you know where you're at, when you know what's coming in and what's going out, and what maybe certain leaks might be out of your finances, the unknown is what makes people feel uncertain. Even if you're not in the right or the perfect spot or right where you want to be right now, just by sheer budgeting, finding ways to track, you know, is a really, really good way to get your footing or get on solid ground. Even if it's not where you want to be at this moment, it can help you to build out a path to get to where you want to go, right? And so we like to introduce, I mean, it's the 50-30-20 rule is pretty common out there. We kind of simplify it down to 80-20, but I wanted to throw that out there. It's very simple when you're budgeting, and we'll have a quick tool and then into market stuff. But very simple for those of you that don't know it. 50% of your budget should go towards essentials, things, you know, like your mortgage, your rent, utilities, different bills, whatnot. Those would be, you know, that rent, groceries would be another, right? Things that you need from month to month to survive. 30 going to things that you want, maybe extra bills or extra things that you may not, you know, need, dining out, going out to, you know, going to see a movie, streaming services, hobbies, whatever that is, right? 50 to what you need, 30 to what you want, and then 20 going to savings, or in some cases it could be debt reduction, right? That you're paying if you're not able to, if you have a large amount of debt or credit card debt or something like that, you may not be able to save. You'd rather put that money towards paying down that high interest debt. So it could be savings or debt reduction. And we also like to throw in a little thing there. You know, Ben often does a 20% rule that maybe you're aiming for 10% savings, 10% to kind of donate, give away, or in some way, shape, or form. But 20 overall to that you're not going to use, that you're either saving away for the future, paying down debt, or something along those lines. So it's a really simple thing, but it's a good framework to use and to think about as you're going, okay, what categories, if you're going the 50-30-20, you know, where does your spending fall? Does it fall into the needs, into the wants, or into the saving/debt reduction, right? We don't want to overcomplicate budgeting, you know, in certain ways. Obviously, you can get very granular with it. But yeah, so there's that there. Tracking and adjusting, you know, it's obviously the easiest way to do it. Tools, right? Technology is the easiest way to go. You have Mint, Rocket Money, or even just Google Sheets, right? Or you're doing a spreadsheet on Excel. There's so many different ways to do it out there. We've seen so many different things work. If you're not super proficient in Excel or Google Sheets, you know, link up with one of these, you know, these different apps. I will throw out there, if you don't have a tool in place, give us a call. Most people probably have something. If you either feel like what you're using is not quite working how you want it to, or you're like, I need something, give us a call. I took a screenshot. Well, not a screenshot here. We have a little image of what our tool looks like. We build off of a different platform where you can pull in a lot of your, you know, your finances. There, you'll see on their budgeting. You can look over your investments. We can, you know, set tasks and things like that, and just kind of tie it into your overall retirement plan. So if you run a retirement plan with us, we also use this. It's built off of the same software. So if you want to tie in a budget to what you're doing, as far as a long-term financial plan, that's a great way to do it. Costs nothing. We cover that cost as a firm. So as a client or 401k participant, which would be, you know, an employee of the company that's a client, we extend those tools to you guys as well. So if you don't have something, don't feel like you got to go out and go start paying a monthly subscription or annual, you know, software fee or whatever for something. Utilize what we've got here. It's really good. It's simple. It's not gonna, you know, it'll do about as much as, you know, any other tool out there will do. It's very competitive there. There may be some that you pay for premium features that this may not have, but if you're just looking to have a budget, tracking your monthly, weekly, monthly, you know, spending, and looking to categorize things, and just making sure, you know, that when you can log into the app and see where your budget's at. Hey, we're at 60% of our budget for the month, or whatever that is. It's really great. I personally, I use this exact one that we have here myself. It's been great. It's been very helpful. You can also have we could create a spousal login. So my spouse and I, we each have our own logins to it that we can view things. on there and make adjustments. She can have different tasks. I can have different things. It's a nice little tool. And so, not to be taken for granted, I want to say, if getting a budget in place, that's a big priority. When we talk with people doing retirement plans, that's the number one thing before you can think about insurance, before you can think about estate planning, before you can think about saving, investing, saving, emergency funds, 401k, IRA, all that sort of thing. You got to have your budget first, right? Because if you're spending more than you're making, you're going in debt, or you have debt that's looming. It's really hard to get to those other, those other places, and especially to start saving. So there's that there. And like I just talking here, once you get your budget in place, these would be kind of the next steps. Once you have some of those that you want to think short-term, long-term, that you want, we're saying, we'd say you want to save up 3 to 6 months of expenses in an emergency fund. Very common. You probably heard that out there before. And use a high yield savings account for those short-term savings. And then anything else near that, if you want to go on a vacation, a car, you have certain buckets that you want to save into short-term wise. Again, tie into our tool. We're happy to put those in there. We can build those plans and those goals not only into your short-term plan, but into your long-term as well, that you can say, okay, hey, I'm 40 years old, working, saving X amount, got this much saved up for retirement. Here's what I'm planning on doing in retirement when it's 65. And in 10 years, I want to go on a big family vacation. Or 5 years, hey, we're going to go on a big Europe trip. And it's going to cost $15,000, $20,000, whatever it is, right? With what I'm saving, with my budget, can we do that without having, or whatever that might be? And how do we do that, right? How much do we need to start saving now, putting away for a trip a few years down the road? And we can build all those in. The more that we can, if you have your budget set up in there, your debt, your monthly payments, stuff like that, we can help you to build out a plan of like, okay, if you save X amount of dollars into this place, then you can have your goal, or if it's a car, if it, whatever it is, short term, but also long term as well. So, it makes room for you to invest for the long term. If you're budgeting, we want to do our best to automate savings. 401k is a great way to do that, to just get things set up through payroll, and it's before it even gets to you, right? It's pulled out of your paycheck before you get your net amount, and it's automatic. Once you set it up, you don't really have to think about it too much. Obviously, you can go change, increase or decrease, but it's something that's relatively automated, which is awesome. And then obviously we throw in there pay yourself first, and that's just a way of saving. So thinking about that short term, long term, balancing those two. These are conversations we have every day. It's hard to have this over a webinar because everybody's in a different spot. You may be, you may be struggling to make ends meet, and some of these things feel out of reach, out of touch. Or you might be on the other end where you're like, I've got a lot of stuff I don't know what I'm doing with, or got a lot of money in savings it's not getting anything, and we've talked about that before with cash management, of like, have that conversation. Let's help you find areas to either get to where you want to go, in either place, right? And help you to be efficient along those ways. And, if you're no matter where your starting point is. So I invite a conversation, give us a call, especially about budgeting and cash flow. Even if you are, you're budgeting and you're tracking it really well, there's still value to be had in a conversation, not necessarily about your budget, but about what you're doing with the extra, or, what your goals are, what you want to work towards, and include us in those conversations. It's fulfilling for us to have those conversations with people. So there we go. It's 10:14. So I'm going to move on. I'm going to take a pause for a second to see if there are any questions that are sitting in here about budgeting. I don't see any. Okay. Didn't expect there would be. And again, for anybody that has hopped in the last 15 minutes, we've been talking about budgeting, which was supposed to be the regular topic for today. But with the market conditions, we wanted to include, some conversation about anyways, about the market, how things are going, what the economy is looking like, and how you can prepare for that, and what we recommend and what we can do to help you, kind of weather that storm. So, and also Q&A at the end of this. We're going to go through questions, probably spend about the last 5 minutes of this webinar going through questions. So if you have any that come up as I'm talking about the market, or just things that I haven't touched on, or that you start filling up send the questions in. Hopefully I explain things well enough that you don't have a ton of questions, but there are always things that come up. So please feel free to shoot those this way. So the big question, what is going on in the market? This is something that, we've been getting calls the last couple of months. It's been a crazy time. And here's some of the things that we've been talking about. And again, if you read Ben's market review and market outlook, he did touch on a few of these things. Now, these numbers are more updated and year to date as of the last couple of weeks. But inflation is cooling down. It's not completely under control, but it is significantly down from 2022. The most recent number is it's about 2.8. It may even be a little lower, maybe 2.4% inflation. Now, I want to make a note that the long-term average, historical average of inflation is about 3.28%. So we are below average on inflation, right? It's under control. Which is good, which is really good for, that it means that over the last couple of years, the tax that the Fed have taken to, pausing interest rate hikes, lowering, raising, like kind of that. I know Ben has talked about on previous webinars, the idea of a ship coming into the harbor, and it's coming in at a certain speed, and you got to decide when to put on the gas. You don't want it to stop too short. You don't want it to ram into the coastline. You want to pull in right and nice. And as far as inflation is concerned, that was the main concern a couple of years ago. It's, the Fed has done a really good job at maneuvering the speeds to kind of come in at a nice pace where we're not slamming into. They would rather, just kick inflation's butt rather than not, but we've seen that it's been pretty okay there. The labor market unemployment is about 4.1% recently. It's weakening a little bit, the labor market. It's still okay. It's nothing, nothing to be worried about too much. But if you look at a historical rate of unemployment, you have, it was, 2008, and it's been going down. There was a big spike in 2020 because of COVID. There was a lot of stuff there. So a lot of unemployment during that period of time during the pandemic. Then it dropped down really low again as, remote working became more possible. The pandemic started, going in the past, and we've slowly seen it rise up little by little. Nothing huge to be concerned about. It's still relatively strong, but just know that it is moving in the direction. It is slowly going up. Unemployment rates are, that is. GDP growth is about 2 to 3%. So, still good there in the positive, which is nice. The Fed has paused interest rate hikes roughly, so about 4.25 to 4.5%. It's kind of holding strong there. So that's pretty typical. I'm sure you've probably heard of that as things are going on. There may be in the next year, hopefully, some reduction, but at least for the next little while, the signals have been that things are going to kind of hold steady there for a little bit. The biggest thing are Trump's policies, specifically tariffs, tax plans also, but tariffs have been the big topic and have made a lot of waves, right, in media, but also just in the market. And we're going to lean on markets here. I mean, the reality is that markets are bouncing around depending on the day's headlines. A perfect example of this would be yesterday. For the last week prior to yesterday, things have been down. The markets are just not liking Trump's proposed and these tariffs. And yesterday, it says, hey, we're going to do it. There's a 90-day pause on certain tariffs, or most tariffs. And there was a huge spike. And yesterday was one of the best days if not the best day of the year for the stock market. I think the S&P 500 was up, I think 9%, maybe, yeah, I think it was like 9% yesterday. The NASDAQ up, I think 10 or 11, just all around, just really green yesterday. So, whereas previously when things, tariffs were very strict and down, but you see up and down, especially with all of these, the markets are trying to price in how some of these tariffs and some of these policies are going to affect the economy in the next 12 months, right? Because they do, as the markets do price out in advance, usually about 12 months in advance of where they see the economy going. So we'll go here. So just so you guys know, as of yesterday, where the kind of the recent market snapshot, like what are things doing? Where are they at? How have they been doing? Like I said, it's been a rough start to 2025. U.S. stocks, so the S&P 500 is a good example of that, is about down 9% as of yesterday. It was prior to yesterday. If you had looked on Monday, I think it was, minus, I don't know, it was in the double digits, the teens, maybe 15 or something along those lines. But as of yesterday, it pulled up a little bit, which was good. But overall, year to date, down about 9%. I think that just kind of shows there's a concern in the U.S. There's a little bit of inflation, not too big of a deal there, but a lot of anxiety around political uncertainty, especially here in the U.S. Global trade issues, and these tariffs. I mean, it seems to, for better or for worse, in the short term, not great, of isolating the United States. And hopefully the hope is in the long term that would strengthen. But in the short term, that those tariffs will pass on a lot of costs to consumers, and that's inflationary. And so there are some inflation concerns with the tariffs, although for the last 2 years, we've been doing pretty good at bringing inflation under control, that for the next little while that there may be some threat of inflation going up because of the tariffs. Hopefully that would be a short term. The hope is that that's a short-term concern with these tariffs, and that, but only time will tell. So, we go through international, up 3.4 international. Europe specifically has done really well. Japan as well. But a lot of places in Europe are doing well, and they're in the positive this year. Certain countries are a little higher than others. But this is looking at, 3.4% as of yesterday, right? Emerging markets, some of the, the emerging are not doing as well as the developed international countries, but there's that. U.S. bonds up 0.8 return year to date is kind of what we're looking at. But good outlook there on bonds, and we'll get to that in a moment. But as you see here, like part of Ben's comments recently is that having exposure to international and bonds have really helped a lot of our clients this year, and anybody that's invested. So it's very important to stay diversified, because you never know which areas are going to do better. Now, historically, U.S. stocks have just done really, really well. So it's not uncommon for there to be a time of pullback, right? Even as recently as last year, where you're up and plus, 29% or something like that in the S&P 500, in the high 20s for last year in U.S. stocks. So it's natural to have a little bit of pullback. Trying to keep a long-term perspective is very important when it comes to investing, because, and we'll talk about that in a moment as well. Cash, about 1.1%. If you take that, that's year to date. It's about a 4.25. In some places maybe closer to 4.5% annual yield, corresponding, similarly to the interest rates that they're at. So cash is doing good. Cash is a good spot right now for to have a portion of your portfolio to kind of hedge some of those losses in some other places. But bonds, again, another good place. International as well. Um, yeah, I think the story so far this year that everybody's seeing is that it's, and we'll kind of blitz through because I know we're running out of time. I've taken a little bit here, but diversification, and I'll skip over this. The idea is it matters, and especially for times like this, it is, you miss out on opportunities, and and subject yourself to more risk when you focus so much on one area of the market. If you had 100% of your money in US stocks, you'd be down 9% this year. Now, as you probably have known, as we talked to clients over the last couple of weeks, majority of portfolios that we work with are not down 9%. Because of diversification, because there is exposure to international, there's exposure to bonds, whether they be intermediate, high yield, or government bonds. There's money market. There's some cash in there. There are things to help because different areas are going to perform differently at different times of the market, right? U.S. is not the greatest spot to be in right this second, but that doesn't mean that things can't change. It's very volatile, and there can be policy changes that in an instant change. Nobody would have expected the change that happened yesterday, right? With the market spiking up. It's hard and nearly impossible to time the market in that way. And so being diversified, staying in the market is the only way to really succeed there. Now, I wanted to bring up this little graphic here, just showing from 1950 until until now, right? 2024, I think it showed. Just to give a bigger perspective, right? I mean, even looking from, if you go back to 1926 to last year, S&P 500 has returned about 10 point. Now, this is just stocks, right? Has returned about 10.1% annually, right? So that's the average, 10% a year over the last, almost 100 years. Now, if we zoom in a little bit, and this image here shows us from 1950 on, you can see, I mean, there's always things that go on that have a very large market drops, all the way, the different wars or different, the dot-com bubble, Y2K, you look after the dot-com bubble, and you're down quite a bit. But if you had, if you had sold out, you lock in those losses. You look over time, it goes up, right? And that's why we want to reinforce a long-term perspective, even if you are in retirement and worried. Now, obviously, you're not going to have 100% of your money in the stock market if you are at a later stage in life, but having some exposure there, this is where growth is happening. This is how we keep up with inflation, is with this growth. And so having that diversification, again, based on your risk or based on your age, we're going to adjust. You're not going to put as much in certain areas, but to have some there, I mean, that's where long-term long-term investors are rewarded. People who have that long-term view. Yeah. So, and then one other graphic I wanted to show here, because some people might say, well, I'm just gonna pull out of the market. This was a graphic that we ran into. The source obviously is Morningstar, but if from 1980 to 2021, this is a little older of a graphic. I liked it, and they haven't done an updated version. But during that time period, if you had been invested all days, $10,000 from January 1st, 1980, you'd have $1.6 million in your account on December 31st, 2021, a few years ago. If you missed just the 5 days in that whole time period, 43, almost half of the value just from missing just 5 days that were the best 5 days of the market. And you could see 10, 30, and 50. If you miss a month from 1980 to 2021, a month worth of time that would be considered the best days, and almost a 90% reduction. I mean, it just shows how much the market rewards people who are invested and stick to the plan, right? Stick to whatever your plan may be. And the reason I bring this up is that you might say, okay, well, you're going to miss some of the worst days, and that's true. But more often than not, I think the number is that the best days in the market are within a week or two. I think like almost 95%. There's a number there, but most of them are within a week or two of the worst days in the market. So when things go down, that they jump up. this week is a perfect textbook example of time, a week where it's just bloodbath, awful. And then one day of that would be, I think in the category of one of the best days for sure this year, if not in the last 5 years or so. Like it's of singular days, going up almost 10% in the S&P 500. That's incredible. That's one of the best days. And if you get scared, sell out, you would have missed out on that one of those worst days. That would have been one of those one best days that you missed out on. So portfolio strategy, stay diverse, rebalance if needed. We can shift things to be a little bit more conservative, and there are some shifting that we would recommend. So if you want to talk about that, give us a call. But I think the idea is take advantage of bonds, take advantage of international. We do work in that. We want to stay diversified because, especially for this year, for the short term, but always, for the long term. So with that, I'm going to turn to questions just for a couple of minutes. Do you recommend buying S&P 500 now? I think the question, overall investing, yes. Now we want to make sure that it's within, if we say, okay, buying the S&P 500, obviously when things are down, that's a good opportunity to invest. It seems counterintuitive, but when things are down, it's buy low. It's an opportunity. If you have the ability to invest, that's a great opportunity to do so. And like I mentioned, long term, that does work out in the investor's favor. Long term, the S&P 500, the stock market, it's gone up. There are points that go down or periods of time, if you zoom in, that it looks negative. But again, if you zoom out, look bigger picture, think long term, that you're rewarded for that. We have another question. For somebody who's rolling over their investments currently, how would this volatility affect them? It's kind of a mixed bag when people move money from one place to another, right? Because you could luck out. We've had people recently that are, just happened to be out of the market during last week, right? Week and a half ago, sell out, cut a check. It's being rolled over to the next institution, and they lucked out. It worked out really well for them, and now we're putting it back in. Time will tell. We'll see what happens in the next, going forward. Next week could be better. Next week could be worse. We don't really quite know. We can kind of gauge, but long term they'll be okay. So it's kind of hit and miss. If you're rolling your investments, that would be how it affected. It's your money is in cash, so you're not losing money. All in all, I would say it's not something to be overly concerned about when you're moving money from one place to another, because again, you're in cash, so that volatility up or down, it's you just hope, that it's either neutral or that you net out. But in either case, if money is out of the market because it's moving, our recommendation would be to get it back into invested as soon as you can. As soon as possible is the best answer. But usually, you're subject to if it's sent in the mail and how long that takes or whatever that may be. So there's that there. We are over time, so we'll leave that there. If you have any other questions or anybody else that sent things in, give us a call, reach out to us. If it's about setting up budgeting, here's our phone number. I'm going to leave this screen here for you. You can email this or Ben or myself directly. I think this email is kind of the general one that gets filtered through. But either way, or just pick up the phone and call us. We're here, and we're available to talk, and we're happy to do so. So if you have any other questions or you have concerns, no need to suffer in a vacuum by yourself, with these concerns. We're happy to talk through them and help reassure and help, make sure that you're in a good spot. That may be reviewing the investments you currently have, whether they're with us or somewhere else, to make sure that you're invested properly or well diversified. Because sometimes you may not be, and we want to make sure that you feel comfortable with how you're invested. So give us a call. We can talk through any of those things. We're happy to help. So that's all we have for today. Thank you for joining. Sorry for going a few minutes over. I'm sure I probably could have talked for a lot longer. Have a good rest of your day, your week, and enjoy the spring weather. I know that it's set to be really warm today here in Utah. So 81 degrees, at least in the Utah County, is the high. So go out, enjoy the sun, and let us know if you have any questions. Thank you.